They say change happens 1% at a time. So, what can you do to be 1% better today? You could take the stairs instead of the elevator. You could give a compliment instead of a complaint. Or you could change someone's life. 1% may not sound like much, but for young people in need, 1% can make all the difference. At Future Generation, we invest in a different kind of potential. We're the first listed investment companies in Australia that deliver both investment and social returns. Future Generation provides shareholders with exposure to the best Australian and global fund managers. Their job? Delivering a stream of fully franked dividends and capital growth to investors. Our boutique fund managers also have big hearts. By not charging management or performance fees, we can donate 1% of company assets every year towards changing lives instead. As a shareholder, you can decide which of our preferred charities will receive your donation, whether it's helping children at risk or supporting youth mental health. Our carefully selected charities ensure your contribution is used in the best possible way. And as our assets grow bigger and bigger each year, so does the 1% donation. This gives our charities the financial security to think and plan long term. By 2044, we aim to have donated $100 million. And the good news is, we're already on the way there, having donated $21.1 million to date. With your support, 1% can make big things happen. To learn more about how you can improve the lives of our future generations, visit futuregeninvest.com.au.
Good afternoon, ladies and gentlemen. Welcome to the Future Generation Update presentation for May this year. We started yesterday in Canberra on the roadshow, and it's fantastic to be here in our home city of Sydney. Now, this afternoon, I'm going to give you a very quick update on FGX and FGG. Now, how many of you here are not shareholders in either FGX or FGG? And I'm guessing there might be a few of you because you're waiting patiently for lunch after this, because normally we have lunch now. So thank you. I'm sure those sandwiches are going to be well worth the wait, as is the presentation. So thank you for being here. Jeff will then also present an update on the investment performance of FGX and FGG. And then I'm going to call up onto the stage, firstly, two of our fund managers. I'm going to call up Ben Griffiths from Eli Griffiths, and he's the Managing Director and Senior Portfolio Manager of Eli Griffiths, one of our FGX fund managers. Secondly, I'm going to call up Graham Hay, and he is the Deputy Portfolio Manager from Antipodes. And Antipodes are one of our fund managers in FGG. So I'm going to do a short panel session with Jeff, Ben and Graham. And then also I'll be calling up Kylie Gibson from Deborah Australia. And Deborah is one of our FGX charities. And Kylie is a committee member over recent years and also is involved in the Family Support Committee at Deborah as well. And also Susan Anderson. And Susan is the Deputy CEO of Beyond Blue. And Beyond Blue is one of our FGG charities. So and then we'll open up for questions. And we promise we'll get you out of here within the hour for those lovely sandwiches. So thanks for bearing with us. Now, for those of you that are not so familiar with FGX and FGG, we're talking here about two listed investment companies. Jeff Wilson is the founder and director of both companies. And FGX is for investors that are interested in investing in Australian equities. And that was listed in September 14. And based on the success of that IPO, a lot of investors said to Jeff, I'm underweight in global equities. Would you be prepared to do a global equities equivalent? So 12 months later, in September 15, FGG was born. And 200 million was raised for FGX in the IPO, and 300 million was raised for FGG. And what we've done in the case, the model for both companies is exactly the same. What we've done is we have approached some of our best performing fund managers in Australia, but also globally, and asked them to manage some money without charging their normal management and performance fees. And as a result of that incredible generosity, and you're hearing from two of them today, the model is with both companies, we donate 1% of our assets to charity. And I'm pleased to say that, as you heard on that new video that we've just shown, to date, $21.1 million in just 4 years has been donated to charity, and it is going to grow substantially as the assets of the companies continue to grow as well. Today, the combined assets of both companies are just over $1 billion, and next year that donation will increase from this year at $7.9 million to over $10 million next year. We've got about 14,000 shareholders now, combined for both companies. And your average shareholder tends to be a self-managed super fund. That's about 50% of the shareholder base. 30% are wealthy Australians, Australian families, family offices, philanthropic foundations, big non-profits, and 20% are mum and dad investors. As most of you know, there's no minimum investment and obviously no maximum investment. When we talk about these two companies, we like to describe them as a win-win-win. Firstly, a win for our shareholders or our investors, because those investors are getting exposure to the very best boutique Australian fund managers and global fund managers without paying management and performance fees. So they are very much the first philanthropic wealth creation vehicles that have a dual purpose. They're providing the investor with financial investment returns, but also a social return. And in very simple terms, the investor is not paying a performance fee, and instead of paying typically a 1% management fee, 1% of the assets are donated to charity. Now, from the charities' point of view, the chosen charities for both companies, it's obviously a win for them. It's a stream of increasing annual donations. And any of you that are involved in the non-profit sector in charities will know that one of the struggles is how do you get a sustainable ongoing funding from a funder, whether it's government or whether it's a corporate or a philanthropic funder. And that's what we're attempting to do here. Lastly, for the fund managers, it absolutely is a way that they can make a unique contribution to the community sector, to the non-profit sector in Australia. And these fund managers we can't thank enough, because if it wasn't for their generosity, we would not be here today. A lot of people ask us, why would these fund managers agree to contribute? I mean, I suppose Jeff asked them or twisted their arm to do it, but they also love the model. They love being involved and helping us do what we're doing here. From an investment point of view, the investment objectives are very much threefold. Firstly, to deliver a stream of fully franked dividends. Secondly, to achieve capital growth. And thirdly, to preserve shareholder capital. I should note, though, with FGG, the global equities company, the investment objective, the number one investment objective, tends to be achieving capital growth more so than even the dividend. The dividend for FGG tends to be smaller and will be going forward than FGX. And the reason for that is we're relying on a group of fund managers. Some of those fund managers in FGG are domiciled offshore as opposed to here. So there's different tax legal structures. And what that means is, in some cases, from some fund managers, we're not picking up the distributions from those fund managers, which directly affects the size of the dividend. So it's just something to bear in mind if you're not currently a shareholder. Now, just taking a look at FGX first here. So we're talking about the highlights, the 6 months to 30 June. Now, firstly, an annualised fully franked dividend of 4.6 cents. Which has been a solid performer, and we're obviously aiming to increase that dividend, particularly on an annual basis. Also, I point out the $6.9 million, the annualised savings. Now, what that is that's the savings from the foregone management and performance fees from the fund managers. And that, you can see, well and truly outweighs this year the donation that we made to charity for FGX to our chosen youth at risk charities. That's the cause area we've chosen for FGX. And that donation this year is $4.3 million. Now, many of you, or hopefully if you're a shareholder in FGX, you will know that we're currently towards the end of a capital raise for FGX. So the share purchase plan, which is part of that, actually closes this Friday, the 23rd of November. And if you are a shareholder and you want to capitalise and acquire up to $15,000 worth of more shares in FGX, you can actually do so. The fixed price is $1.18, and it's trading around about that level at the moment. Obviously, there's no brokerage fees because it's a share purchase plan. And also yesterday we announced that we had a placement that occurred last Thursday and Friday, and we raised $43.9 million from that placement, which we were pleased with, considering the current volatility of the market, which of course has particularly been happening since mid-October. And we actually announced this capital raise on the 8th of October. So that's just a reminder about particularly the share purchase plan. And you have to be a current shareholder and a shareholder as at the 5th of October to actually participate in that SPP. And what we're trying to do is ring every single shareholder that we've got a phone number for. So we're just about there, and we're aiming to finish those calls, close of business tomorrow. Now, these are the 14 FGX charities. So these are the charities that we've carefully chosen in the youth at risk space, the children and youth at risk space. These charities over time could change. Today you're going to hear from Deborah Australia and some of the fantastic work that they do. We make sure that these charities do proper progress reporting. We're very close to these charities in making sure that they're transparent, they're accountable, and most of them, if not all of them, actually do operate nationally. And as I said, you'll hear from Deborah a little bit later from Kylie. Now, these are the service providers. These are the businesses behind the scenes that are either working for us pro bono or with heavily discounted fees. And like the fund managers, we can't thank them enough for their tremendous support for FGX. And most of these same businesses are supporting FGG as well. CommSec, for instance, have waived their normal brokerage fee. We're the only two companies listed that you can sell shares on with CommSec, where you're not being charged a brokerage fee. The ASX is not listed here, but with the ASX, they've actually waived their annual listing fees. Again, we're the only two companies listed, we believe, anywhere in the world where we're not paying the annual listing fees. So the ASX has been incredibly generous. Now I'll talk a little bit about FGG, the sister company of FGX, and this is the one that, as I said earlier, Global Equities listed in September 15, so it's basically 3 years old. The total comprehensive income, $25.7 million. The $5.4 million, so we're talking here about the annualised savings from the foregone management and performance fees from those fund managers, and also the $3.6 million, and that's the investment, the donation that we've made this year for FGG. And the cause area we've chosen for FGG is youth mental health, children and youth mental health. We really believe that that's a cause area that we wanted to concentrate on for FGG. Now, with FGG, these are results. We actually did a capital raise for FGG, and we did that in September and October. And thank you to those of you that participated in that capital raise that are here today. The share purchase plan was completed in October, and we raised $30.8 million from the share purchase plan, and that was driven very much by strong demand from existing investors. 2,727 shareholders participated in that. We have about 7,000 shareholders in FGG, so we were particularly delighted to see those shareholders participate, and we raised $97.1 million from a placement. Now, that result was pretty good because for those of you that have got good memories, the market went pear-shaped on, I know the date because it was Thursday the 11th of October, and the placement actually took place on the 12th, the next day, and Monday the 15th. So it was tough timing for us, but we were particularly happy with that total amount of 128, considering the timing of the placement itself. Now, with FGG, these are the 8 charities that we're currently supporting in the children and youth mental health space. We chose that cause area, not because we're experts on mental health, but we absolutely believe that mental health is chronically underfunded by the private sector, whether it's corporates or philanthropists or donors, let alone by government. And we felt that over time, we could play a real leadership role in actually encouraging more funding to happen in mental health. And I'm guessing every single one of you, because I know with me, we're affected. Someone in our family that we work with, or more than one person in our family, in our close network, is affected by a mental illness of some sort. And we're absolutely committed to doing something about that issue. In fact, on the 30th of October, we actually organised and hosted at Ernst & Young in Sydney the very first Australian Mental Health Funders Forum. So we brought together an interesting array of case studies, investors that want to do something about mental health and the lack of funding. And we presented basically a forum. We were particularly happy with how it went. We even had Ian Thorpe presenting at the end in conversation about his lived experiences with mental health issues. We actually had the host of The Bachelor and The Bachelorette, for any of you who watch that show. Is a bit addictive if you need to really unwind at the end of the day. But Osher Gunsberg actually opened the forum as well, and we had some really serious case studies that were presented throughout the afternoon. Now, these are the service providers. These are the businesses behind the scenes. Very similar set of businesses that are supporting FGG as well as FGX. I'll just note there's probably one exception here, Steadfast. Now, Steadfast have very generously donated the fees for the cost of our audit every year for FGG. And I was sitting next to the managing director of Steadfast at a lunch during the IPO for FGG. This is back in July of 2015. He said, you know, I absolutely love this model. I love the fact I'm going to invest myself, but what else can I do? And he said, you know what? How about I actually donate the cost of the audit fees each year on an ongoing basis to support FGG? And what that does is that actually keeps the costs of the two companies right down. And that's one of the things we're pretty proud of. I mean, I'm actually the only paid employee of both companies. So I sit in the WAM office as part of the senior team there. My salary is split three ways. The two companies fund a third each. WAM actually funds the final third. And WAM currently has, I think, about 32 staff. And when I first started, nearly 4 years ago, there were 14 staff. So it's gone through quite a lot of growth. And of those 32 staff, half of those staff are actually delivering work for the success of FGX and FGG on an ongoing basis. And I'll give you an example. There are two fantastic finance managers that work for WAM. They actually work in the WAM finance team. And they purely work full-time on FGX and FGG, and their salary is fully funded by WAM. So FGX and FGG are very much part of the DNA of Wilson Asset Management, and we have tremendous support behind the scenes, particularly from that business, to make these companies such a success. Now, I know Jeff is due to come in shortly. He's just at the AGM of Global Value Fund upstairs, so I'm actually going to just start his section of the presentation, and he'll sort of just glide in when we see the tall man come in. So these are the fund managers for FGG. So as I said, thank you to these fund managers, because we would not be here today and FGG and FGX would not exist. These 14 fund managers are not charging their normal management and performance fees. Most of them have been with us since inception. Over time, we have made some changes. So at any point, the investment committee could remove a fund manager. It wouldn't do that lightly, but if it did, there would have to be consistent underperformance, or for instance, maybe a key personnel leaves. So I'll give an example. With FGG, when Peter Hall left Hunter Hall a couple of years ago, and it was quite sudden, the investment committee met immediately and decided that it was the right time to exit Hunter Hall as a fund manager of FGG because Peter was actually leaving. But typically it would be more likely to be consistent underperformance. With these fund managers, we have removed, I think, about 6 of them in the last three years. And there were probably 3 or 4 of them that were removed early on, and that was when we felt in the first sort of 12 to 18 months we had a bit too strong a skew to Asia, and it was actually affecting the performance. So we did actually have to go to those fund managers and say, look, unfortunately, it is time. So we wouldn't do that sort of thing lightly. More recently, we've added Munro Partners. They're probably the most recent addition, and in fact, Nick Griffin from Munro is actually presenting for us tomorrow in Brisbane. Caledonia is a more recent addition as well, so they were added about 12 months or so ago. Now, the investment performance, so here you can see how FGG has performed. Since the last year in particular, you can see the outperformance there of 3.5%. It's had a particularly strong 12 months. And as I said, in that first sort of 12 to 18 months, we had a bit too strong a skew towards Asia. We fixed that. And also we had options that expired in September last year. And once we got those options out of the road, the share price rallied and we'd had a particularly strong 12 months. Now, if we look at the NTA and the investment strategy allocation for FGG, you can see here the pre-tax NTA currently is 131. As at 31 October, it's been trading at about 131, so it's in line on par with NTA. And you can see here the skew of the investment strategy allocation. I mean, typically the investment committee, which is chaired by Sean Webster, would typically have around about 40–50% in long equities. As you can see here, also we've currently got 32.3% in cash. That's quite large compared to what it has been in the past. And one of the reasons for that is we've just recently completed the capital raising, and we're due to make those allocations shortly about what's happening with the money that was raised, the $128 million that was raised from the capital raising. Now, if we take a look at the allocation, so this is currently which fund managers have how much allocated, what percentage of the portfolio is allocated to each. And you can see here Antipodes, and you'll hear from Graham very shortly, has the top amount at 8.3. Magellan Asset Management, Frank Casarotti is here, thank you Frank, who's also on the board of FGG, have 8% currently of the portfolio. So these percentages could change a bit over time, but that's currently where it stands, and it will change once we've done the allocation from the capital raisings coming up soon. Now, the FGX fund managers, you can see here we've got 20 at the moment. These fund managers, again, thank you, and of course Ben is one of those from Eli Griffiths. We've more recently added Firetrail. They're the ex-Macquarie guys, and also QVG. Over the 4-year period, we've only removed 2 fund managers out of FGX, and these guys, it's been a solid performer, FGX, over the 4 years. Now here you can see the actual the numbers. Since inception, it's outperformed 2.8%, and more recently in the last 12 months, 1.8%. Now, if you take a look at the far right-hand column, the standard deviation since inception, and this is us trying to keep that as low a volatility as we can. You can see the 7.4 versus the market's 11.2. We're pretty happy with that figure. I mean, you always want that figure to be as low as possible. With FGG, I'd have to say that figure is probably it's higher than that, and the investment committee is very committed to working towards reducing that figure as much as we possibly can going forward. Now, the NTA, we're currently, as at 31 October, pre-tax $1.17, $1.18 if we round that up. And you can see here the strategy allocation, the investment strategy allocation, typically looking at long equities around about that 50% mark. I mean, you can see here also, basically fully invested with the cash currently at only 0.9%. And obviously that will change once we've come through the capital raising. So the investment committee will obviously be meeting and discussing that allocation once we close the SPP at the end of this week, and we know how much we need to allocate and where. So finally, this is the allocation. So here you can see the portfolio, the fund manager allocation amongst the 20 fund managers. We're actually in 23 funds, and you can see Paradise, L1 and Eli Griffiths are the 3 fund managers that we're invested in more than one fund. Paradise currently has the most allocated at 12%, and it scales down from there. Typically, from the outset, no one fund manager would typically have more than about 10% actually invested with them. And part of the reason we've done that is if for instance, we put I don't know, 50% with Eli Griffiths, for instance, and we love Benny and what he's doing, what might happen then is his fee-paying clients might actually decide to dip out of the Eli Griffiths funds and come into ours. So, you know, we don't want to do anything that would adversely affect the business of the fund manager. So that's typically why no one fund manager would have more than about 10%, certainly from the outset anyway. So I think that's probably it from me, just for a bit of an update. Now what I'd like to do is call up Jeff Wilson, the founder and the director of FGX and FGG, to participate in the panel. And I'd also like to call up Ben Griffiths, Graham Hay, and Kylie Gibson, and also Susan Anderson to the podium. And I'll act as the moderator. Thank you. All right. Well, look, I normally start with the fund managers, but what I might do is actually start with our two charities today, if that's all right. We'll have the ladies first, if the gentlemen don't mind waiting. That'd be great. So, firstly, to Kylie and to Susan, the first question is really, for those people that are not aware of your organisations, I'd really love you to do a little elevator pitch, you know, in a couple of minutes about what your organisation does. And Kylie, I'd love to start with you because you know, Deborah focuses on a particular disease called EB, and I'll get Kylie to explain a bit more, but Kylie's son actually passed away as a result of this disease, so she really has, you know, first-hand knowledge of what we're talking about here, and I really want to thank you for being here today. Kylie, over to you. Thank you.
Yeah, I'm from Deborah, Australia. We support people, it's a very rare genetic condition called epidermolysis bullosa, EB for short. That means children are born with skin missing, and it's because they're missing the protein in their skin layers. So for someone like me, just rubbing, that's fine. But for someone with EB, just rubbing can shear the skin off or cause blistering. And once those blisters break, they turn into wounds, which then in turn turn into chronic wounds. So I had a son born, Joshua, back in 2002 with the recessive type of EB. So he was born with skin missing from his legs. He had skin missing from his hands just from sucking in utero, and because we had no real nursing EB literate at the time, he then rubbed his face. So half his face was missing his skin by the time we got the proper care. So I became involved with Deborah when Josh was about 6 months old, so that's probably over 16 years now. And I was first involved in the New South Wales branch, and then probably 2008, 2009, all the state branches conglomerated and we became a national body. This was just to overcome doubling up on supports and trying to get funding for different states are battling for the minimal funding that was available. So since Deborah National's been up, we've sourced funding for the generous donation from FGX. We have funding for nurses. So when Josh was born, I had no nursing support. It was just the nurses on the ward coming to wrap him up, and no wound care experience. So they sort of caused a lot of damage to his skin, which then the wounds healed or they didn't heal. They were just ongoing wounds. So now we have nurses come in who are experienced in EB, recommend the right dressings to heal wounds, how to bath the baby, advise on feeding, because with the severe type like Josh had, it affected his esophagus. So just the simple art of eating became an issue. So the esophagus lining could come out. So we had to have special feeding techniques. So yeah, FGX have helped supported bringing the nurses in. Parents aren't so overwhelmed. Like I remember a week into having Josh, they're like, yes, take him home. I'm like, I can't, I don't know what I'm doing. And they didn't know what they were doing at the time either. So, but now families from the get-go, once Deborah notified, nurses come in, help solve a lot of problems, coordinate doctors, different services that are required to care for an EB baby. So we've got the nursing. We currently fund a paediatric nurse down in Melbourne. And we're also currently at the moment trying to get a transition nurse, because once these children get older, they've got to transition to an adult hospital, which again, you're losing all those experienced EB doctors from childhood. So then you've got to go out, find new teams of doctors, nurses, and different services to help support them live their life. And currently at the moment, we're trying to get in a psychology program. So at the moment, it's running in Victoria and New South Wales, just as a pilot program. And hopefully in the next 12 months, will be a national program. Because living with EB, a lot of our families are isolated just from wound care, which I know myself, doing my son took 3 hours a day. So our routine was to get up at 6 in the morning, rush to get ready to take Josh to school by 9. So, and as they get older and become adults, bath time takes a lot longer. So it's a lot of mental, Josh had a lot of issues around pain, constantly living with the pain, and you're isolated. Like on a hot day, we'd be invited out to a barbecue and I'm like, sorry, we can't go. The heat just exacerbates blisters. So it's a lot isolating for the family with the person with EB. So hopefully bringing in psychologists, our EB sufferers can help get strategies to put in place to help them live a more independent life.
Right. Oh, thank you, Kylie. It's fantastic. And in Kylie's spare time, she's a disability worker as well. So, I mean, you are incredibly committed, I have to say. It's amazing. So thank you, as well as your voluntary work with Deborah.
Thank you.
So, Susan, can we shift gears a bit and could you tell us a bit about the work of Beyond Blue?
Sure, Louise. And I think that Beyond Blue is probably more of a household name. As Louise said earlier, we've all been touched by mental health in some way. 3 million Australians in a year will live with depression or anxiety, and 8 people currently per day will die by suicide. So Beyond Blue's mission is to assist everyone through a range of different settings. In schools, we're in preschool, primary school, secondary school, really trying to build strategies to help to build resilience, to ensure that people don't progress and to get anxiety or depression. So really to support them, what strategies can we ensure that people can maintain really good mental health? We have a support line that's available 24 hours a day. We have 170,000 people per annum. That's fully funded by Beyond Blue, not by government funding. So FGG is incredibly important to those sorts of initiatives that we actually offer. We also have a forum. People in rural areas or city areas can go on and communicate with each other. So we really see ourselves as helping 25 million Australians. We see that mental health is everybody's business, same with suicide prevention, and we want people to understand what can help them towards recovery, because you can recover if you take action, and we really encourage everyone to look out for each other. What can you do to support your family members? What can you do to help the community around you? And so we are available for all of those supports.
And Susan, Kylie touched on a little bit about what the FGX funding is supporting. In your case, can you tell us a bit about what the FGG funding is going towards?
I can, Louise. So this year it's over 320,000, which is a phenomenal amount of money. And we've developed a resilience practice guide that can be taken up by professionals. We know that children before the age of 18, 50% of mental health issues that occur later in life have really occur between 0 and 14. So if we can get in early, we can make a significant difference in impacting that child's life. So we've built a resilience practice guide specifically with this money. That's now available to all of those health practitioners. It's in schools, it's in the hands of 16,000 professionals. We know that it's contributed to our website, Healthy Families website, which reaches 300,000 to 400,000 people. So that's one component. The other thing that we're putting the money towards now is our web chat. So as I indicated, we have health professionals who are online web chat. We know young people engage in web chat, and something like about 25,000, in particular young girls around the age of 15, will go on and reach out for a health professional to get some assistance. And we've got to make sure our apps, our technology is really up to date. So this money will specifically help that. And we know that if a young person reaches out for help, that's a fantastic sign, and we want to be there in that moment when they seek help. And that's what this money is contributing towards.
Fantastic. Thank you, Susan. And just to finish up, Kylie, is there anything that the audience can do to support Deborah? I mean, obviously they can support you by being an investor and ticking the box every August and voting for Deborah when that 1% is allocated. But is there anything else people can do to support the organisation?
Just EB awareness. Like every now and then in the media we do have like a news story about EB and how rare it is. Many years ago our family was on domestic blitz, so that raised a lot of awareness, and I still get questions now about EB. But just talking about rare diseases, there's a lot out there, and just having a chat with someone about EB, what it is, a skin blistering condition, or even just have your own little fundraiser. We have a lot of little community groups that will just they might have a morning tea or a trivia night and raise funds for our EB people. So just, yeah, getting out there, raising awareness, having fundraisers, donating.
Fantastic. And I must tell you that Deborah does have some amazing ambassadors. Ben will attest to this because last May we had one of the ambassadors, Dean Clifford, from Deborah, presenting on stage in Brisbane. And he is quite an extraordinary individual. I mean, to look at him, to see the EB was quite confronting. But he's a motivational speaker, and we've actually had him into the WAM office, and he really was quite extraordinary. But also, he's quite a phenomenal weightlifter. And in fact, we discovered on the stage that he outlifts Ben, which Ben wasn't happy about. I can't remember, was it 140 kilos or something?
120 kilos.
Yeah, it's pretty extraordinary for this guy, and I don't think he should be alive today. I mean, he's 38, but he's quite an extraordinary individual. So thank you, ladies. Look, now we might change direction. And now we're going to talk to the all-important fund managers who have made this all happen. So I might start with you, Ben, first, and I'll ask each of the three of you for your view on the market. Thanks, Ben.
Sure. Thanks, Louise. Great to be here again, ladies and gentlemen. Yeah, well, I guess no one's missed what's happening in global stock markets at the moment. We've got ourselves a good dose of volatility. And I choose, as Jeff will attest, so often I do tend to don the bullish hat, but not always. On this occasion, the bullish hat is remaining on, Jeff.
Good man. Yeah, that's why we're sitting beside each other, because I tend to be a bit more bearish.
Indeed. So what we've got is we've got a situation where stock markets globally have been advancing pretty well since 2009. So we've had a 9-year bull market. We haven't had much in the way of a proper correction, and I strongly believe that what we're seeing now is not a topping formation, is not the end of stock markets as we've known them in the last 9 or 10 years. It is in fact a good old healthy correction. And I say that with some confidence. I guess I have experience having seen a few market corrections in my time, but a little bit more fundamental than that, of course, is I guess the backdrop is a US economy that is strong but cooling, but still strong. We have the basic valuation backdrop of what we call the earnings risk premium, which compares dividend yields with bond yields. And that particular measure is flashing to me that, if anything, bond yields and earnings yields are around neutral. Equities, meaning equities are not especially expensive. The yield curve that we often look at, and so many in this room will hear about, which is a good measure of, are we staring down the barrel of a recession coming, or are we in a growth phase? It's still nicely positive and steep, which suggests to me that the broader economic setting in the United States, for instance, is positive. And we've just had a terrific reporting season in the United States, and we're almost through that. So fundamentally, equities are not topping, equities are pausing, equities are correcting. And equities normally do this around the time of a midterm election in the United States. We just had the midterms, and equities, guess what, they're correcting. And I saw an interesting article, or actually it was a diagram in the Wall Street Journal last week, which highlighted the typical secular structure of how a bull market plays out. And at about year 9, if you can overlay the last 50 years of equity markets, about year 9, the market seems to struggle and falter and correct before recharging ahead of the next leg upwards. So at the risk of leaving everyone with this wildly bullish impression, we are in a maturing bull market, but we're in a bull market that is going through a very necessary reset in pricing and resetting in valuation. But the underlying fundamentals aren't so bad. So I think the market, Louise, looking through the volatility, is reasonably well positioned, albeit mature in its advance.
Thank you. Thanks, Ben. And Graham, love to hear from you.
Sure. Yeah, look, I think the way we've been viewing the world coming into 2018 is against the backdrop of what's been the world's largest coordinated central bank intervention program that we've ever seen. And the way we've sort of contextualised that is to say that it's really been that intervention is the scaffolding by which global financial markets and economies have been rebuilt. And it's worked a treat. I mean, if you go back to 2009 or 2008 at the worst of the crisis, the central planners at the time would have bitten your hand off if you'd have given them the scenario that we now have today: relatively full employment, animal spirits alive and well, stock markets hitting new highs. You would have taken that scenario straight away. Now the difficulty, though, is that the scaffolding that was so effectively deployed is now being dismantled, and we're about to be left with the after effects of that. And so you have to, I think about different regions and different asset classes, how they've dealt with that environment of very easy money, easy access to credit, very strong risk appetites amongst investors, and understand what's going to happen sort of thereafter. And if you go around the different parts of the world, I think different regions have done a better job at taking advantage of those those tailwinds and backdrops than others. But looking forward to us, we think the volatility very much is a function of a world where we move from one of credit expansion to one of credit rationing. Credit rationing is real. Ask anyone that's tried to get a mortgage on an investment property this year, they'll tell you that credit rationing is alive and well. It has an effect on businesses, on consumers, and ultimately on financial markets. And so as we go into this new environment, we think volatility certainly is here to stay. Volatility, by the way, is a euphemism for falling share prices. If you look at what's actually played out this year, the transmission effect of this tightening is pretty, I guess, in some ways predictable. It hit emerging markets first, then flowed to Europe. America was relatively protected up until October, but we're now seeing the effects of that tightening regime start to kick in the US as well. Whilst the earnings picture and economic backdrop in the US are very good right now, they do benefit from some unusually strong and maybe not sustainable stimulus. The effects of repatriation, tax cuts, and what looks to be just a very uniquely strong US economy have all been great tailwinds for markets. They may not repeat next year. So I think some of the things you've been investing in the last 4 or 5 years, it's time to think about rotating out of those things, looking for some of the less obvious ways of making money. And if you have the ability to short stocks, I think that will hold you in pretty good stead as well.
Right. Okay. Jeff, is there anything you want to add? I mean, I think most of the people were here earlier, but if there's anything you want to...
I mean, big picture, I'm bearish. You know, my view is the bull market's over. You know, the Fed hasn't successfully... Well, what you tend to find is when interest rates start moving up, the market continues to perform. Then when interest rates keep going up, you know, that's when the market turns over. And I mean, just the comment was, you know, we've gone from QE to QT, you know, quantitative tightening, and the impact's going to be felt on asset prices. And the thing that concerns me a little bit more is domestically, if the betting agencies are right, and there's an election in May, and Labor wins, then you don't tax your way. Taxing doesn't stimulate economies. No. So, you know, they'll increase, you know, the tax take. And you know, I remember when the GFC started, you know, we all hadn't lived through an experience like that before, and I was trying to work out how do you deal with this. And I remember reading an article that Fisher, you know, the economist wrote, you know, in the 30s about the Great Depression, and he was saying for every dollar you tax, consumption declines by $1.7. So, you know, I'd say assume Labor get in, then we've got a recession, you know, latter part of next year in Australia domestically. So, you know, maybe the market's anticipating that.
Okay, well, on that cheery note, I might just thank.
I know, but
yeah.
For those that weren't here earlier, yeah, bear markets are very short.
Yeah, of course.
I think Martin was saying the average bear market lasts 1 year. So
Not
don't
that
be.
long.
Yeah, we'll be back. We'll be back with you, Benny, on the bull.
Yeah.
Or it could just be. Let's hope it's a correction.
That's assuming we've qualified for a bear market right now, Jeff.
Correct.
You've made some big claims that we're in bear market setting up.
Correct. We could be wrong.
We could
be wrong. Hey, I hope you're right.
All right. Now, I know this is a favourite part of the presentation for a lot of people, but I'd like to ask the three gentlemen for a couple of stock picks and investment ideas. So can we start with you, Ben? Everyone's ready, poised?
Sure, Louise. I happen to have a couple of ideas handy. One stock I'd like to talk to today in particular is a stock that it's a company that everyone in this room would have had some involvement with at some point in their lives, and that's Cabcharge, which was a darling stock going through the 2000s. The share price got to $10 when Reg Commode ran the business. And then unfortunately, from about 2005 onwards, Cabcharge has been caught up in somewhat of a tailspin actually, in unfortunate asset purchases, changing regulations, the advent of technology and ride-sharing technologies, and before you know it, Cabcharge, for many, many years, almost 10 years, could not get out of its own way. There has been an event, I guess, in the last year or two occur at Cabcharge, and that is a business that is looking to reinvent itself. Not so many businesses can do that. Reinventing a company is hard and difficult, but Andrew Skelton, the CEO, who hasn't been there that long, is engineering a turnaround in Cabcharge that will take some time. So essentially it involved divesting some assets that business probably shouldn't have in this day and age. It had a London-based cab company, no surprise, and it had a bus company as well. Well, it divested those assets. It then looked at where the business hasn't been investing, and they had been chronically under-investing in their brand, Cabcharge, and in the technology. And they have spent the last 2 years basically going about investing, and that investment process continues, investing in the brand. Cabcharge, you'll see now as you walk out onto Pitt Street, 13 cabs, that's the new brand. And the software investment has been enormous in making sure that they're every bit as fast and as flashy as Uber is. 130 software engineers are making the business of Cabcharge, bringing the business of Cabcharge into the new age. So that's occurring. They've lost market share to Uber and Taxify. Again, perhaps not a person in the room that hasn't caught an Uber. Well, I think you'll find that we think the penetration of Uber and other ride-sharing apps has kind of run course, and Cabcharge is making a big comeback. And finally, just coming back to being a boring old stock picker, it does come back to valuation and balance sheet as well as the story that's unfolding. And valuation is not so bad at about 17 times and about 15% earnings per share growth forecast for this year and next. And balance sheet, there's basically lots of cash on balance sheet with Cabcharge. They have cash to invest, to spend, but essentially remake the business. So, Louise, I'm saying Cabcharge, soon to be renamed as A2B Australia. Cabcharge is a turnaround story, a beaten down favourite from days gone by that below surface is doing some very smart things. I think it'll be a great performer.
Great.
And Benny, the terrible thing is, I know occasionally, I think when we were on this last time, we had the same stock, didn't we?
We did, and you were stuck for words, Jeff, as I recall.
But we, yeah, that's right, exactly. But it did go up. I think people made good money.
Of course, absolutely.
But actually, Cabcharge was going to be my sown pick.
Oh, is that right?
It was.
Oh, really?
Right.
Oh, okay.
But
a double endorsement, ladies and gentlemen.
The boys like it. The boys like it.
Even the Bears swung around. He's,
there you go.
He's happy to
own hibernation.
Happy to own Cabcharge. Thank you, Louise.
And do you want to give us a second one now, or do you want to?
Second one I was going to mention over a sandwich outside with a few people, but why don't I mention it now?
Yeah, go for it.
And the company is Nearmap, and Nearmap is a photo map digital imaging business that essentially takes terrestrial photographs or photographs of the landforms, but from 14,000 feet in a plane. It's a very detailed, highly specialised practice. This business has about a 25% share of the photo imaging business in Australia, and they are taking their technology and their know-how and their experience to the United States. And they've been doing that for several years, of which they've got, I think, approaching a 1% market share. There is enormous scope to grow this business. And the other day they mentioned that having raised $70 million, they're going to put the money into the United States, into a few hybrid technologies here, but they're going into Canada as well, Louise. So they're going to tackle Canada as well. So this is a good old Aussie export story, doing some very, very smart things with good managers. We think this stock's one worth watching, if not buying.
Yeah, what was the name again? Just
Nearmap.
Nearmap.
NEA. Nearmap. One word. Nearmap.
Fantastic. Great. Okay, thank you. Thanks, Ben. Good contrast with the two of them. Now, what about you, Graham? You've got a couple there for us?
Yeah, I was going to tell you about a company called Cabcharge. Not really. As you know, we have a global remit at Antipodes. We have a strong value bias as well. So the two companies I'm going to talk to you about are amongst the most malign industries in recent times, telecoms and gold. Both, however, we think are long-lasting assets. The first company is a company called KT, which is the dominant Korean telco. I used to call it the Telstra of Korea, but that's no longer a very kind reference. Let's just say it's the former state-owned monopoly in Korea. It has a couple of unique attributes that we really like, and it's quite helpful to reference what's happening here in Australia with the build out of the NBN network, where we're spending, I haven't seen the latest numbers, but it's in the order of $60 billion to achieve nationwide fibre rollout. In KT today, you have an NBN contained within that company already, so those costs have already been sunk. And keep in mind that $60 billion number. KT also, as a result of its history as a state-owned monopoly, has a very large real estate portfolio. That's actually been carved out into a separate legal entity. It's wholly owned, but is a separate operating business, which has, we think, a mark-to-market valuation in the order of about $7 to $8 billion US dollars, generating rental income close to $700 million a year. So you've got the internal NBN, you've got the real estate assets available to you for an entire market cap for the entire company today of about $6.5 billion US dollars. So this is a pretty uniquely cheap asset in a sector that's been heavily out of favour. Telecoms, Telstra's not alone. If you look at telecom assets around the world, they've been under enormous pressure in the last decade. And you have to be very careful across the sector because the different regulatory regimes, different competitive environments mean that there are reasons to be cautious. But in the case of KT, we think it's a uniquely powerful franchise and is set to deliver very strong free cash flows over the next 5 years. And with that as a backdrop, we think the dividend can go up a lot as well. So that's a nice attachment. So KT is the first one. It trades on the trades obviously in Korea, but it also trades on the New York Stock Exchange under the ticker KT. Accessible, relatively accessible for most people. The second company is a company we've owned for a few years now, Barrick Gold. And I guess the important point here is to understand the backdrop of gold equities over the last decade and what's happened to them. And essentially, they've gone from wildly overvalued assets that were the first port of call if you wanted to get exposure to gold, to being a brand new industry that have embraced the principles of capital allocation. And the reason that they've done that is because investors now have an alternative way of accessing gold, which is gold ETFs. So what you've seen happen, arguably rightly so, is a massive derating of gold equities over the last decade, reflecting more the fundamentals of their businesses, which are in many cases quite difficult. But what that's done is it's catalysed a rethink in the way these companies are run. There's a much greater focus on capital allocation, generating returns on incremental capex, and being very strict around commissioning the next mine to make sure it meets sort of traditional hurdles. Now, in the case of Barrick, they've just announced the acquisition of a company called Randgold. Now, the interesting point about that acquisition is that it was done at zero premium. And that's very unusual when the management and shareholders of Randgold have agreed to sell themselves for zero premium to Barrick. And it's very typical of a bottom of the cycle situation. But in getting Randgold, they bring in one of the best credentialed CEOs in the industry that's going to run the combined company, and they get a very good producing asset that puts them at the bottom end of the cost curve amongst gold producers globally. So look, we think in a world where the tailwinds to rising equity valuations are maybe dissipating, that gold can return to its rightful place as a store of value and a port in stormy seas. Good,
thank you. Thank you very much, Graham. And Jeff, do you have a couple of quick ones for us?
I'll just give you two. The first one's a global one, and that's the one I mentioned at the Sohn conference, Bandai Namco, which is a video gaming business which has significant exposure to the mobile part of the video gaming industry, and that is one of the great growth industries globally. Video gaming running at 10% growth per annum, and mobile, the mobile segment is growing at over 20% per annum. And it's on a PE of 13.5 times, adjusting for, it's got 20% of its capitalisation in cash. And we think the catalyst to change that valuation will be some earnings surprises. It's Japanese based. You probably would have heard of Power Rangers or Pac-Man or, our age, and then the younger people might have heard of Dragon Ball Z. They're all their IP, and they've got really high quality IP. And they went into China a couple of years ago, and that'll be a great growth market for them. So that's that one. And the other one is Austal Ships, or Austal it's called now, the shipping business, and makes ferries as well. On a PE of about 13 times, growing at 20% per annum, and it has it's quite good visibility for that growth. We think it'll grow at that rate for the next 2 to 3 years. So they're the
great. Thank you. If you're not a shareholder investor, please consider and also become a subscriber. We have our monthly investment reports, our NTA updates. We also have a monthly newsletter. We do these presentations every 6 months, and we're very happy to talk to any shareholders or potential shareholders. I'd finally like to thank each of you for being here this afternoon, but I'd also particularly like to thank our panellists, Graham, Kylie, Susan, Ben and Jeff, for giving up their time and sharing with us all this afternoon. Thank you very much.